let's take a technical look at the markets. Ron Williams with us today, technical strategist at MIG Bank. Thanks for coming along, Ron. So we have got three charts that you've brought along today, all on the topic of the yen, but from different angles. Why don't we start with the first one, the dollar yen verging on a 40-year cycle reversal. Tell us how this works.
Well, this is one of the biggest trade opportunities that are likely to develop into 2012, and it's basically a 40-year long-term cycle which is reversing to the upside on the dollar yen. Now, key thing to keep in mind is that this is going to symbolize a change in mass psychology, which will basically change the ways that safe haven flows have been funding into the Japanese yen, as well as the popular carry trade, where investors have been used to borrowing from the Japanese yen as the funding currency and investing in high-yielding markets. So we should see a significant change over the next month or so based upon this long-term cycle.
Hi, it's Pedro here. A quick question for you. Which level on the dollar yen would trigger for you, would validate that you've seen the reversal you're talking about?
Well, the key trigger level, which I've highlighted on one of the shorter term charts on the screen, is 80, the big psychological level, and then thereafter we have 83.30 and 85.50. They're the more intermediate levels to keep an eye on. But the key psychological level is 80. I do believe this is going to be maybe a two-stage trade setup where we might see record lows first on dollar yen before we actually see that major reversal. And I can explain that maybe on the other charts.
Yeah, let's move on to the second chart that you brought along for us, Ron, which shows this breakout pattern and sentiment. Want to see that one?
Yeah, sure. Well, this multi-year breakout pattern, which is shaped as a wedge pattern, just basically shows that there's a high probability of a breakout to the upside over the next few month or so. But if we see sentiment measures based on the options market, this highlights at the moment that sentiment might be overheated, as many people in the market try to maybe call the bottom on dollar yen. So potentially there may be a need to flush out some of the overheated bullishness in the market before we get that major reversal higher.
Okay, and the final chart you've brought along on the same topic, which shows the this post-intervention retracement. Well, let's do that one.
Yeah, sure. Well, this is an important chart for investors and traders out in the market to understand, is that, I mean, basically throughout history, the last 10 years worth of intervention events on the Japanese yen has proven that markets tend to fall back to pre-intervention levels. And we've seen this happen time and time again. And the third intervention that took place over the last few months, just very recently, is no exception. So we should more than likely see a post-intervention retracement, something I've called PIR, so a move back to pre-intervention levels, but also a potential post-intervention new low beneath the post-World War II record low at 75.35. The key levels I've highlighted there are at 80, that psychological level, 83.30 and 85.50. These are the key upside trigger levels. Really recommend that people actually wait for that confirmation, because dollar yen has, I mean, so far been quite volatile. It's still proven to be the house of pain trade. And so it might be best to either wait for confirmation above those key upside trigger levels, or maybe try and alternate into the options market to try and hedge for that upside risk that we're likely to see over the next month or two.
Okay, Ron, thanks for that. Ron Williams, technical strategist at MIG Bank.